All right. Good afternoon, financial professionals. I'm Phil Haug, Senior Vice President with E4 Insurance Services, welcoming you to the Brew, building relationships every week. Thanks for tuning in today. For those of you joining Brew for the first time, welcome. We'd like to start the Brewcast by celebrating today's national days. Today is National Hot Air Balloon Day. Today is also National Thank You Day, and it's also Awareness Month. So I'm sending up my thank yous in a balloon, and hopefully we have a fantastic discussion around annuities today. Today's brew, we're going to kick off June's Focus Planning Series, Annuity Awareness Month. Doug Twiddy, E4's Director of Annuities, and myself are going to talk about how E4 can be your annuity expert with strategic guidance on the precise annuity product for each of your client's specific needs. We encourage you to use the chat box or raise your hand to ask questions. All attendees are entered into a drawing for a CE voucher and a Starbucks gift card, and we'll announce the winner at the end. Thank you for tuning in, and also thank you for Doug for joining us today. Doug, I will hand it off to you.
All right, well, good afternoon, maybe morning for some of you guys. Thanks for jumping in on our first Annuity Awareness Month brew. And I really just wanted to go through and cover a couple of topics. Since this is the first one, right at the beginning of the month, I'm hoping we could do a high-level touch on some annuities, just to cover the different product types, and then hopefully get you to understand more of why E4 is the best role fit versus maybe our competitors, since we all offer, for the most part, the same products, carriers, things like that. We do bring a different vibe, though. So if I can share my screen, I know, oh. All right, are we shared? Just want to confirm.
We are shared. We're good to go.
Good deal. All right, so one of my favorite pieces is the Annuity Solutions Weekly. It gets updated every week and it gets sent out in a mailing list, email list every Monday. So I want to run through this because I think it's vital that you understand that this piece exists and that you understand how to go through it and why you should look at it. It also allows us to touch on each annuity type. I'm going to zoom in a little bit here just in case. So our first product type we'll go over are MIGAs. And please understand that if you don't do annuities or you're not very familiar with them, please come ask all the stupid questions you want. I love stupid questions. I'll feed you a fire hose. You'll remember part of it, and I'll feed it to you again the next day, and we'll keep going through it so you can learn it as well as you want to. So if you don't understand any terminology or you have questions, maybe write the question down since we're doing a high level, and that's a good reason to reach out and have a conversation either later today, tomorrow, or whatever best works for you. So our first one are MIGAs, multi-year guaranteed annuities. They're like CDs at a bank in a sense. And the top here shows the different terms that we have available. And as of right now, the best carriers and their product that matches it, the ratings, if you want to see the particular rating. And if you don't like B++, reach out and we can look at something that's a 10-year that's not B++, or maybe we can have a real conversation about a carrier and their financial stability. The minimum premium needed to reach a certain rate, because you'll see sometimes it's not 100,000. And then the free outs, so the access that you have to it in year 1 or years 2+, and the max age available for that rate, and then the rate that you can get. So of course, the biggest one right now is United Life, 5-year guaranteed rate at 5.75%, and it's 10% free withdrawals every year. So great product, great carrier, great option, and we're seeing a lot moving there. To skim on by, we'll go down to fixed indexed annuities. Most of our advisors like to stick with the S&P, right? We don't do a whole lot of the hybrid indices, and the ones we do try to do our homework with them and see what their realistic returns could potentially be. But we point out on this sheet the best S&P caps on a 5, 7, and 10-year product. And ironically enough, right now they're all 12%. So Symetra has the Elite Edge 5 and 7 with 12% on years 5 and 7. Pretty good renewal integrity. And United Life's Wealth Choice 10 has a 12% cap. And they've got perfect rate integrity on this product ever since it was first created. All 3 products, 10% free withdrawals in year 1 and in years 2+. And then with United Life, you only need $20,000 to get that rate, whereas on the 5 and 7, you're going to need 100. Also, another piece right under the others, if they're available, this particular product does have a guaranteed lifetime withdrawal benefit rider. So not only can you get lifetime income out of it, you can also get a really high cap available. Now this cap may go down when you add the rider, whether it's the product changes slightly or just simply because of the rider fee that's attached to it. But we can have that conversation when the time comes. Then we point out any other interesting index strategies, and sometimes we'll put in here an index that's not the S&P if we feel like we wanted to promote it for any particular reason. Right now, the three that we're pointing out, two of them are Global Atlantic for accumulation. Again, they've got perfect rate integrity. I think it's 14 years with this product, and they have continued to keep caps and bars where they were when they were originally issued. They're both with the traditional S&P 500, and one is a cap lock, so rate integrity doesn't matter. Right, you can get a 10.25% S&P cap guaranteed locked in place for 5 or 7 years. Or you can do an S&P trigger at 9% on the 5 and 7 years. So it's slightly lower. However, if the S&P is not down, you get the full trigger. So whereas if it's say 4%, here you're only going to get 4, and here you would get 9. So do you take the cap to potentially get that extra between 9 and 10.5 if it's above 9? I guess that's a decision you and the client would make. Lincoln OptiBlend 5, they've got about 90% rate integrity, but they have an interesting one. They have an S&P 500 daily risk control, 10% daily risk control, and it's a trigger. So the 10% daily risk control has been around for about 11, 12 years. We can look at real data, and the trigger is much higher. It doesn't move quite as much as the S&P 500 up or down, but it does move very well along with it. Very similar, and I can get into more details with that if you want, but as long as the S&P 500 10% daily risk control is not negative, you get 10.75%, which is a pretty competitive rate, right? Not locked in place like the 10.25, but it's also just like the 9% trigger, which could fluctuate slightly. Move down to the bottom of page 1. Obviously with SPIAs, right, income annuities, immediate income annuities, there are lots of different ways that we can run these. We had to pick something to throw on here just as a general idea. So we picked a 10-year period certain. In this fashion, it doesn't matter what the age of the client is. It's just the rate, right? 10-year payout. So here are the top 5 monthly payouts and the top 5 annual payouts for $100,000 single premium annuities. Keep in mind this Penn Mutual, which has a 3 next to it, and the Nationwide are both Medicaid compliant products. So if you have a client that's trying to, in a sense, save some money, stash it, not have to spend it down for Medicaid compliance for long-term care, these are 2 products that we can have a conversation about. And if you don't know much about that, give us a call and let's talk about it. Phil, any questions you can think of before I move on to page 2? I feel like I'm rolling through this part fairly quickly, which is fine because it allows me to move into potentially annuity rate watch to show some bullet points in there as well.
Yeah, I just wanted to highlight. So this is a resource that we've had available for quite some time. It's been part of our Secure for Life newsletter that comes out every single week. In light of kind of market highs and clients that have been capturing, locking in their gains, 2023 was a banner year for amount of annuities that were placed in the industry. I'm at a conference right now, and the fourth quarter of 2023 was as much annuity business as the entire year of 2019, to put it into perspective. So annuities have really come to the forefront with individuals looking at it. We wanted to pull this out and highlighted it. So each month or each Monday, you'll be getting this pulled out in addition to the Secure for Life newsletter, and you'll be getting the annuity weekly, which shows you the different options that are available to you. And with that, Doug, once you've gone through second page, I'll just kind of set you up for the next component. And that's obviously there's a lot of options. Obviously, there's a lot of carriers. When you're working with an advisor on identifying a solution on what's best, what are some key pieces of information that you need to help? You talked about the benefit of working with us is there are a lot of different things out there. We're going to help you pick the best one, right? What are some, the question for you after you finished explaining the sheet is, what are some key components and some information that you need from the advisor to help us identify what the best solutions are.
Okay. All right. You want to do that after page 2,
After
just to make
page two.
sure.
Yep,
Okay.
yep,
Just make
So
sure
go
we're
through
together
page,
here.
go through page 2 and then go into the go into what the advisor can help to set you up.
All right, perfect. So page 2, we'll get through a little bit quicker, oddly enough. So this top section are fixed indexed annuities or traditional fixed annuities with guaranteed lifetime withdrawal benefit riders. So basically just lifetime income, except we're not doing a SPIA like we are up in here where you're going to annuitize. We're not annuitizing these. These are funds that are still going to be, I can't really say liquid because they're under surrender charges, but they're still your client's money. And we're showing a large amount of data in a small sheet. So the idea behind here is whether you're looking at a client that's age 60, age 65, or age 70, we can get a general idea of where some numbers are going to fall, right? So with those clients, we can look at whether they are single or whether they're joint 60, right? And here again, single 65, joint 65. And if we want income now, these are going to buy, these will be our values. So on $100,000 single premium, a single 60-year-old could get $7,200 a year for the rest of their life, right? So that's a level income. If they want increasing income, they can get $6,140 for the rest of their life. Now, the increasing value, we've got to have a conversation about what that really means because that changes by product and when it would potentially stop or why it increases and how much it increases. So you can't look at this as a cookie cutter just as well as you can look at kind of the level income. But again, 60-year-old that are joint can get $7,200 a year, which is almost identical to a single, right? And up here, the joint and singles are identical. So it doesn't matter whether you're dealing with a single person 65 or a couple that are both 65. We can give them $8,000 a year for every $100,000 they put in. But what if they want to defer 5 years and they want to do income soon, not income now? So this is a 5-year deferral. So it's a 60-year-old deferring to 65, right? Or a 65-year-old deferring to 70. Again, single and joint, level and increase in income. And you can see the income that they'll get on day 1 for the rest of their life. And if they want to defer income even later, right? We want to go 10 years. So 60 deferring till age 70 for income, right? More ways to look at it. Another way to potentially consider this, which is why I like the fact that we used $100,000, is it makes it very simple to look at this and determine the percentage of the original premium that could be paid out as lifetime income, right? So it's 8.7%, right? 17.6%, right? A 70-year-old, a joint 70-year-old deferring to 80 could get 17.6% of their income at age 80, guaranteed for the rest of both of their lives. I think that's a pretty compelling story. That's an easy conversation to have when you can look at it that way. Then the last 2 pieces we have on here, you know, annuities aren't just about accumulation. They're not just about safety. They can be about other things, right? They can be about repositioning of assets to help hedge against the costs of long-term care. So one of the big products that we use or advisors love is the Global Atlantic 4Care, right? So a male age 65 with $100,000 that's just sitting in some other non-qualified account, highly appreciated, we can move it over and we can give them $308,000 of long-term care style coverage. So $4,300 a month for 72 months, and we can issue it up to age 80. And it's pretty easy to qualify for. There's only, I think, 8 health questions that go along with it. Also comes with a pretty competitive interest rate internally. So the original premium is actually guaranteed to be higher than it was on day 1. And if you never use the money, that passes to a beneficiary as well. So we're not even really losing money to the cost of long-term care. It's just protecting the rest of that portfolio. And if you have somebody that's a little bit older, they're trying to find a good, safe way to grow their money to potentially pass it on for wealth transfer, give it to their kids, grandkids. We've got several options available for there. One of our biggest ones is National Western, their capital solutions, and we can guarantee 10% simple interest roll up for 10 years, right? Up to age 75. If they're above age 75 when it issues, it's 8% simple interest roll up for 10 years. There is a rider fee built into it that does not deduct from the roll up. And then whenever you pass away, it pays out as a lump sum, or it can pay out as a lump sum to the beneficiaries. So a great option for wealth transfer in there as well. And this credits on a daily basis. So you don't have to worry about passing away at month 10 and losing out because you didn't make it to the policy anniversary to qualify for that roll up. But that is 2 pages to give you almost everything you could need when having a conversation with a client, at least long enough to gather data and give us a call for some better direction. So bounce back and forth to Phil. You were asking data needed to sort of have a conversation and point in the right direction. And that's where I guess I feel like E4 comes in. I get lots of interest. I get advisors that love having the conversations with me once they really open up and they start talking about a client instead of just saying, hey, can I get the best, 7-year S&P cap? And it's like, well, let's have a conversation about the client if you're willing to, right? You have all the information on your client for you to put together a plan and you understand what it is that you do, right? But you guys typically come to us because this is our specialty, right? I don't manage portfolios. I don't do investments. I do annuities and that's all I do. So if I understand more of your client, I can help guide them in better ways. So the more information that we can have, whether I know it's a single or a joint, or are we scraping together, pennies to gather this kind of money together, or do they have a large amount of money? Do they have children that they want to pass money to? What does their health look like, right? Did they have a long life family history? Do they have a family history of Alzheimer's? What things can we potentially protect against while doing what it is you think we want to do with this money? So instead of going after an S&P cap to do safe accumulation, maybe we redirect and we do something like the capital solutions, because the real objective is to handle wealth transfer, right? So instead of getting a 10% cap on the S&P, we can guarantee you 10% simple per year for 10 years, right? And then it passes on to the children. This product also has a very competitive S&P cap in it. So maybe they live the whole 10 years and they didn't plan on living that long, right? But now they need that money. Well, this product would have given them a very real possibility of having a higher account value as well. So it kind of falls in with that fixed indexed annuity, but it has this backup security piece. Benefit solution, same thing, right? We get a 25% bump on day 1, and then you get a 25% bump at year 5 and at year 10. A little higher fee, and then the payout is not available as a lump sum. Maybe you want that, right? Maybe the clients think their children are going to spend the money too quickly. They don't really want them to have them as a lump sum. So we can set it up to where they have to take it over 5 years in order to get that enhanced value. But any information that you're willing to give, I love to have those conversations. I love to help point in the right direction. I love to feel like we've got the right product for that client and that you feel comfortable with the solution, or a couple of solutions really that I've given you for you to choose what you think best fits for your client.
Yeah, and you can see that when it comes to annuities, it is more than just what's the highest rate, right? So,
Yep.
when we look at these solutions that are available, when it comes to money that's sitting there, essentially all money is designed to do one of 3 things, right? It's either going to be passed, it's going to be spent, or it's going to be just in case, right? So if you've got a client that's got money that's sitting there, it's an old annuity, it's a money market account, CD, you name it. It's a safe tool that they're using, right? It's helpful to find out what's the goals with it, right? And you can see that from what Doug just detailed with. Obviously, he's extremely knowledgeable with the solutions that are available to us, but there's a lot of different options that we can go with it. So if that client's designed to have that money to consume it, right? They need it for income. We need to look at some of those options. If it's designed they want to pass it to the kids and they're no longer insurable, well, then we need to maybe look at a death benefit rider. Maybe they're sitting there and they're concerned about the expenses that come with long-term care or skilled care. There are options that are available to them. So by understanding the customer and leveraging the relationship you have with E4 and with Doug, you have kind of unlocked you kind of got the key to the lock to figure out what's the best solution for them. So while we wait for any final questions, I'd like to remind you that today's brew will be on our full library and recorded and shared on the brew blog on our website at www.e4.insurance. And today's recording will be posted on our brew blog. I keep tripping over that, and emailed to advisors later. So Doug, for our giveaway, pick a number between 1 and 27.
1 in 27. I like 27. Let's go with 27.
All right, and that's Shane Nowasaki's lucky number. So Shane will be getting complimentary CE and a Starbucks gift card. So hopefully doesn't need that extra caffeine because he's excited about all the options he has with E4 and the solutions that he has available. But on next week's brew, we will continue Annuity Awareness Month with Ken Booth, Director of Advanced Consulting Group with Nationwide. More and more of clients are inheriting funds as their parents or siblings pass. The rules of managing these funds have changed based on several factors, but we must learn how to handle money properly. Ken will help explain the rules around inherited money. Thank you, everyone, and we'll see you next week for the brew.